if the government raises interest rates, the stock market's at an all-time high. This morning we had great retail reports. If the federal government gets good indications and data that the market is going up, they have a tool that they can raise particular interest rates. Now, what raising interest rates does is it makes money a little bit harder to get. It makes money a little bit more expensive to be able to borrow. So theoretically, companies will borrow less, and when companies borrow less, they slows down their expansion, which relates to people payroll. People may not spend less, and it's a tool to kind of cool off the economy. And when companies borrow less and quit expanding, it can hurt their revenues and profits and may affect the stock market in that way, to where people may go into a higher interest rate society thinking that, hey, the market could affect negatively. Now, to go more in detail to how this relates to you, I have my special guest, the 40-year Wall Street veteran here, James Foytlin, calling in from Wall Street. James, what do you have to say as far as explaining it to someone right now? What are the federal government interest rates and why are they important?
All right, so I'm going to grossly oversimplify this to make it so at every level, people, the listeners will understand what I'm talking about. The Federal Reserve has a key rate that they will lend to banks, like big banks, like Citibank and all these, and J.P. Morgan and Chase and all these big banks. And the banks say suddenly they borrow money from the Federal Reserve at a 1%, and now the Federal Reserve raises it to 2%. Now they won't raise it a whole point in one shot, but I'm just trying to make a point here. So how does that affect you? That means that, say, Chase Bank, if you go to get a mortgage, that raise is going to be reflected in those mortgages. So at every level of the economy, the price of money, in other words, interest rates, will go up. So it reflects. And Prince was 100% right. In theory, that's how it all works. Money gets more expensive, so businesses and individuals spend less because it's more expensive. The car that you wanted to buy or the house you wanted to buy at, say the house at a 5% mortgage that you could afford at a 7% mortgage is too expensive, so you can't buy the house anymore. So these are the kind of things that happen. My point is twofold earlier on, is that what I think is, because rates are at this historically low, it's like an anomaly. They're not even at the norm yet. And I think that we have a little wiggle room here where the Fed can raise rates with very little backlash on the economy, because the rates are just so low, it doesn't make any difference.
Now, James, now that we're in this historically low interest rate society, how one who's an investor or maybe a common investor, do you see any opportunities one should be taking advantage of? For example, you were saying, hey, you go to borrow money to buy a house, the interest rates are low, and the interest rates are going to go up, what's going to make it more expensive to buy a house. Should I be capitalizing on the low interest rates to buy a house? Or would you say, hey, is there any other things that you can see that I possibly could be taking advantage of as far as like a common investor? What's some things that maybe some opportunities there that you may want to look at in a low interest rate society like this?
Well, first of all, businesses that are very capital intensive traditionally get very hurt when interest rates go up. For example, historically, utilities would get hurt if interest rates would go up. The real estate business would get hurt when interest rates go up. A lot of industrial companies who had to lay out a lot of money to borrow and build big plant and equipment would be hurt. I would say that, but however, the flip side of all this we've got to remember, because I think we have a little cushion here for a while, because what you have to weigh is the impact of interest rate increases against all the other things going on. Are the impact of interest rate increases going to outweigh economic growth? Are they going to outweigh deregulation? Are they going to outweigh all the other factors that are going on? So you have a balance of that. And I think there's a lot of opportunity to make money now because the economy is, if the Fed starts to raise rates consistently, they're telling us the economy is growing a lot faster than it's grown in a long time. And so you would look at industries that could take advantage. For example, today, retail sales were a lot bigger than they had been in a very long time. There's other any industry that's like that where people that's because of that can do well off a growing economy. I would say that a lot of it is the typical stuff you'd think of. Companies like technology companies that offer consumer goods will probably do really well for a while just because the economy is growing faster. Some older traditional industries, like perhaps people are going to buy more cars. Now, mind you, it has to weigh, is the economy, the better economy, good enough to outweigh the slightly higher price you're going to pay in interest rates? That's what every investor has to weigh. I would say, though, you're more apt to watch out for certain things. Like, I probably wouldn't be buying bonds in this, especially longer bonds in this kind of environment. I wouldn't be buying utility stocks in this kind of environment.
James, to piggyback on that, why wouldn't you be purchasing bonds? Why do you say, hey, bonds,
Well,
wouldn't be a good
yeah,
look right now?
bonds are bonds always are like the opposite. Like if interest rates go up, bonds go down. And it's basically a simple process because if you have a 10-year bond and it yields 2% and interest rates are 1%, that bond yield is based on the duration, the 10 years, plus the credit quality of the bond.
Okay.
Now, suddenly, interest rates are 3%. And your 2% bond, the price has to reflect a new reality in interest rates. So the price of the bond itself may go down. The bond will still pay if it's a good company and it's all good credit rated, it will still pay the dividends all the time. But the price of the bond is going to go down to reflect it. It's going to take that 2% yield and now it's going to make the yield 3%, which means the price of the bond itself is going to have to go lower at market value to reflect that higher yield.
Okay.
And so you don't want to get involved in any of these like long-term bond funds, just buying bonds out too far. This is not an environment to buy bonds, especially long-term.
Now, like you said, hey, bonds, maybe not so. But I like what you highlighted earlier when you said, hey, well, think about things that customers buy because, and the reason why I say that's a good thing is because think about it, right? Like we said, borrowing money is very cheap right now. So you can borrow money for very low. So companies can borrow money for very low, which they can use that money to expand their business, hire employees, come up with new products, pay higher salaries and stuff like that. Unemployment is at a historic low. I mean, people theoretically have jobs. And when people have jobs and they make more money, they spend more money. And the thing about that is, well, when people make more money, they spend more money, and also they are approved for more credit. Now, when they get this credit, then that means that they usually go buy more stuff because let's be honest, most employees, when they get paid, they buy stuff. So what you mean like cars, not maybe cars, clothes, stuff like that. So I can understand the correlation where you can say, hey, things that can see a spike are things that are consumed by customers, like things like maybe your retail or your grocery stores and grocery lines and stuff like that, because people will have a tendency to buy more. Am I making a correct statement on your analysis there?
Oh, yeah, absolutely. And what I'm saying is under normal circumstances, raising rates would maybe slow that process down. But because we have this historically like below normal interest rate environment, interest rates could go up quite a bit. And they're still, even doubling from where they are, they're still very low by historic standards.
That is true.
It's like we have like a window here where we have a very unusual circumstance where I think rates can go up quite a bit, yet it's more of a sign that the economy is really taken off. and that
Mhm.
things are good. Like under normal circumstances, it might say that the economy is overheating and that inflation is boiling up and like maybe some negative things are coming. But I think in this particular situation, it's kind of an unusual situation because of the 2008 financial crisis and quantitative easing and a bunch of other weird stuff that are all thrown in there.
Okay, and that's a very good. And the thing that you're old school, right? I got into the
Real old
investing
school.
world around like 2007, 2008. So, before the 2008 crash happened, financial recession happened, interest rates around about 4%. And now, they've ducked down to already, it went to zero essentially. And now we've kind of
Right.
seen a little uptick. So, in my investing experience and history, we've kind of always historically been in a low interest rate environment. But you coming from the 90s, 70s, 80s, you're like, hey, this is extremely low. Because
Yeah, I
if
mean,
if I go back over a
traditionally,
60 chart,
4% is
uh-huh.
a very low interest rate.
Yeah, that's true. Because when 2008 happened, everybody was like, well, interest rates are already low. At that time, I didn't understand what interest rate really was. I mean, I knew what interest rates was in general, but I didn't know how the Federal Reserve and Jane Yellen and Alan Greenspan and what was the CEO of Goldman Sachs? His name is Bernanke, right? If I'm saying,
No, that Ben Bernanke
yeah,
was
Ben,
the Fed chair after Greenspan,
yes.
and then Yellen was after Ben Bernanke.
Hmm.
Ben
Okay.
Bernanke is often referred to as the Bernanke, like people just call him the
The
Bernanke. I
Bernanke.
don't know why, but that's what he's called. That's his nickname. And
Okay.
the chairman of Goldman Sachs is Lloyd Blankfein, but that like the often a Fed governor is more an academic economist. They
Okay.
usually don't come right from Wall Street, but that's not into 100% true either.
Okay. But like now that Fed chair, we're seeing how important that is and how it affects our everyday economy and how it can even affect
Yes,
our investments, even us buying homes, loans, credit cards, and stuff like that. But James, we're getting
yes.
ready to close out the show. Is there anything or any advice out there that you would want to lend to any watchers or listeners or anything like that?
Well, again, I want to repeat, and this is because we went from like a historically low. For example, when in the 70s, when
Hmm.
interest rates were very high, we used to talk about the heyday of the 50s when interest rates were 4 and 5% for 10 years, and that was considered the good old days where interest rates were very low. Now we're
Wow.
in a period where we would have to have a fairly significant interest rate increase to get up to 4% or 5%. And what I'm saying is, unlike normal circumstances, this is an unusual circumstance due to the financial crisis in 2008. And so there's a big window here. And I think for investors, this is further evidence that I think the stock market is still going to go a lot higher from where it is here. And I think that this is, from a business standpoint, I think this is further evidence that the economy is starting to pick up a lot of steam, which it needs to. Because
Okay.
even though, as you pointed out, we have this big employment number, which is still a little debatable about how many people are actually employed or unemployed. The biggest problem in my mind is there isn't income growth for the regular guy. The regular guy is probably making less money than he made 20 years ago,
Wow.
and that's a big problem.
And to make that even more important, the federal government, they control what comes on our money market accounts, our checking account, our savings account, the interest that you earn. And we're in a very low interest rate society. So you have to invest because what the federal government is giving you in your checking, savings account, CDs are not even matching inflation. So you have to invest some type of way. And we're at a stock market right now that's at an all-time high. We low unemployment and all the other great stuff. But anyway, guys, my name is Prince Dykes. This is the Prince of Investing. Guys, don't forget to hit the like, subscribe, comment, and share button. And don't forget, each and every Tuesday, we will be here. I want to thank you guys. I want to thank our very special guests. Thank you guys for tuning in. Until the next episode, podcast, and next Tuesday, thank you guys. Peace. Be safe. I'm out. Thank you. And hopefully we don't get canceled.